Hey, I'm really excited about our conversation we're going to have today, Andy. We talk at least 2 to 3 times a week and dropping off our kids at school in the morning and just talking through like some of the conversations we had in the prior day or the prior week. And we felt like it was best to just bring it to the forefront and just, have two professionals go back and forth on some common questions that we're hearing. And I find it to be very interesting that we could be working in different parts of our great country and hearing similar questions. But right now, one of the questions that I'm hearing quite a bit, I'm going to pose it to you and we're going to kick this back and forth a little bit is how can I optimize my investment portfolio to maximize returns and minimize risk?
Well, what a great question just to load me up with, right, on a general conversation. But, I mean, we've been talking so much about, how do we reposition clients' portfolios. And I know we just spent a great week at Prime Week a few weeks ago. And I know we got a little bit of slack on the wonderful coding of PPP. And, when you're really thinking about it, right, Jason, you and I talk all the time. How do we really take traditional approaches and mindset that our clients have and then maybe think it a different way, right? We're in a different world, a different economy. And so ways that I know you and I are talking about, I mean, I'm talking a lot about when I talk about PPP, I'm talking about public market exposure. I'm talking about some of your assets need to be protected, and we've talked about how those that are accredited investors, need to have some private market investments. And especially now in this world, it's there. And, an interesting kind of factor that I want to throw in, and let's throw this back and forth. But I tell clients all the time, it's important to have public market allocation. Why? It's available. It's a good place to have return. We haven't been in an environment where the bank accounts have been friendly for us, right? And so public markets is where we go for the long haul. The benefits of the public market is it does have liquidity, right? It's got some other opportunities to look at historical information, but that comes with our key fun word of volatility. So when we're talking risk transfer and diversification, the volatility is what you get in the public markets.
Well,
And
you get that volatility as well, Andy, because of the availability and that liquidity. I mean, there could be a run on a mutual fund like there's a run on a bank, right? Like the mutual fund manager could be doing a decent job, but then people are just divesting out because they need the money or whatever, or they're just trying to market time or manage risk. Who knows? But they will have to start selling off positions before they want to, driving down further the redemptions or even down the position of the net asset value of the mutual fund. So not to get too geeky, but that liquidity, there's a pro and a con to that liquidity, and we see that in the public markets, and that's where risk management really comes into play. But then let's talk about private markets. How do private markets come into play as far as overall risk management of a strategy?
well, yeah, I mean, and everything is, everything comes with risk, right? We can't escape it. We can either fully have it through liquidity we talked about, but the private markets, especially if we're talking to our audience of accredited, investors, which is determined, right? You got to make sure you have enough income or net worth that the government and the higher rules officials tell us what we can and cannot be in. But the benefit of private markets is that they're not correlated, right? And correlation is if the markets go up and down because of all the news and the reaction that people have, the public markets don't get exposed to that. They're audited on a schedule. There's some opportunity in there. They usually have some holding period. So you buy a company for a private equity and you sell it, or you own real estate and you own it, make some income along the way. So the private market is really it has really been able to soften some of that volatility is where I'm going with it, right? Um, and it's an important part of portfolios. Funny thing, Jason, I'm jumping real quick. We had a great partner that we work with one of our private equity partners was here in Wichita and was talking about the value add or the reason why private markets make sense as a part of someone's portfolio. And his big comment, he had a great stat. I wish we could pull it up. We might have put it in the meeting notes, but just the fact of the number of companies that are staying public or I'm sorry, staying private or going private more than they ever had. Right.
Yes.
So
Hmm.
why would you want to, in the past, you think about it, a private company would go public for what reason? Right. For liquidity. You IPO it, they're trying to get the highest price and then it goes into the market. In fact, who was it? I just saw a company, I'm going to have to look it up. They bring it all back in house just to take away the market volatility of their stock price. And so companies today are moving back to the private space because they have more control of their balance sheet and, more importantly, their audience.
Yeah, we have seen that contraction in the private markets. Like a number of listed company stocks on the US market in 1976 was 4,796. So just to say 4,800. In 2019, that was 3,643. So a rather significant reduction in public markets. So what are they doing? They're staying private longer or not even going into the public market. And going back to portfolio diversification, you're talking, I like what you said about risk and return, but there was a study done by JP Morgan Asset Management that looked at annualized volatility and returns from 1989 through September of 2021 by allocating 30% in private markets. And what they were able to show and look at through this long period of time was that additional diversification lowered the risk and improve the returns on these strategies. So using public and private assets was able to show how to navigate through this. Now, the other component that they did not discuss, but I think is part of important of our conversation, which is the third P, which is protection. Drop some knowledge on me on the protection side, because I think this is an important topic.
Well, it is, right. And but protection has just kind of been beat up over the years, we both know it, the annuity word is usually not a good word in our industry. Usually, right, we both sit there and we talk about clients that need annuities or insurance. When it boils down to it, clients need to find a way to transfer the risk to somebody else. Right. And that's more challenging. You think about the public market, you put it in, it comes out, you take the risk of anything that doesn't work out to your benefit. Same with private markets. Not all private deals are going to work out, but you burden the risk. So how do we bring that into the conversation has been, I know more out there, and annuities are kind of the quick and simple, easy solution. I know you and I have participated. There's a lot of differences there, but, outside of just that, right, we're starting to see structured notes, and we'll talk more about that. We're starting to see some downside protection markets where you can actually buy an investment strategy, right? That you don't burden the first, 10 or 15% of the downside of some index strategy, but you got to commit to it. So that's the key thing I think around protection is protection strategies of the P are committed. Normally they're not liquid. They're not illiquid. We just have rules to follow.
Yeah, they're like semi-liquid. You get access to some, but not majority, and you got to wait certain periods of time. And it's because of that protection that's being provided by the company. I mean, there's nothing that's going to fit all the boxes, right? Low risk, high return, and full liquidity. If that was the case, everybody would do it. Why not just do that? And no one could tell us what's going to happen in the future. So having your money diversified between those three Ps is something that we talk about. You and I both talk about, I would say, on a consistent basis. And this is a second question that I get. Should I consider alternative investments such as private equity, hedge funds, or real estate? I'm going to kick it over to you, Andy. What are your thoughts?
Whatever right? I mean, I think Warren Buffett's always known invest in what and then that's the best way to manage risk. And so, I mean, if you're in a market and if your center of influence, your circle is real estate professionals, then go to what you know. You're going to have a lot, right? I tell clients all the time, you're going to be more comfortable and willing to let the strategy play through because nothing we do is an overnight sensation, right? Everything we do is always going to be long-term. So stick to what you know. Private equity makes a lot of sense right now just because if companies are being bought by a private equity group, right, they're being bought because they need liquidity. And so they need to sell. And if you need to do anything, you usually are not going to get what you would want, your want price, as I tell people. And so, I mean, when answering that question, hedge funds are good. You can get some public exposure. They do come with a little bit higher cost, but stick to what you know. I heard it, the multifamily boom is going on right now. I'm sure every single person that would ever listen is seeing multifamily between duplexes to quadplexes to apartments being built in their communities across the country. We're seeing them all over the place, and there's some really great returns and some opportunity if you want to own a real asset. But you got to know who the people are and the opportunity.
Well, I hear what you're saying, but this is where people rely on professionals that know how to go about this. In Richest Man in Babylon, if you haven't read the book, it's a phenomenal book. It even goes in there and says, surround yourself with people who are familiar with money, who work with it each day, and who makes lots of it. Enjoy life while you're here. Do not overstrain to save. And I find that to be very important, where if you don't know enough about private markets, surround yourself with people who do, professionals. I'm not talking about the person that's at the country club, okay, that's saying, hey, I got a hot deal. No, no, run that through your professional that knows how to vet these things. It's
Yeah.
so important. I was talking to Tim Hakes, our good friend, earlier today, actually, about the private markets and some of the things that he was seeing. He was like, let's say I'm working with like a business owner. Well, they typically like to go into the private markets because they know how to evaluate it and be a part of it. So it goes with what you were saying earlier, Andy. But he goes, but my job is like, if we're going to allocate, let's say $5 million to private investments, that could take us 3 to 5, 6 years to do so and do it right. So we know what we're moving towards. It's just the timing of when the deals come through that actually meet our criteria to then be able to execute within it. And I think that's such an important point that we got to get conveyed. Do you have any other? Do you have any additional talking points about this topic specifically?
Well, yeah. I mean, why don't you throw in, I mean, you look at this too, but and again for a completely different segment, but the added tax benefits. I mean, when you look at it, the goal of investing is to increase your portfolio assets over a set period of time based on your risk profile. But sometimes, and many times, we don't take into account. I mean, when on your statement do you see gross return, net tax return? Never. That would be interesting. And if you start to factor in inflation and other these other influencers to your statement, it's got to bridge beyond the statement. And so when you're talking about what our topic is today that we talked about, how do you optimize a portfolio? I think the number one thing that you kind of hit on was it takes time. You and I start with everything that we center around as our clear picture approach, right? And clear picture takes into account. That's why we started with PPP. Having a good understanding of where our clients' assets are located helps us determine where they should be, and that helps us, to your point, of how do we, over the next 2-3 years or whatever time frame, incorporate either the downside protection strategy or add in some of that stuff. But we got to start with the foundation, and that's the most important. And then we can look at all the benefits. A good friend of mine always has said, features are for information, benefits are what people buy. And and at the time we focus so much on features, sometimes we miss the benefits, and taxes are a huge benefit when it comes to optimizing your portfolio, is my add
Right.
point.
I wasn't planning on having this conversation today, but let's jump into it because you brought up taxes. And question I keep on getting is what are some of the most effective tax planning strategies for high net worth individuals?
Well, let me tell you, the only strategy that I see, and this is again what you and I talk about, right? But um, I'm sticking to the traditional. I mean, there's a lot of strategies, but the number one strategy is have a tax strategy.
Is to have
Listen to
one.
it,
Is
just to
to
have
have
one.
one.
Yeah, I mean, think about it right now. If you're listening to this today, we're talking to our clients. You and I both have it. I mean, most people don't sit down and say, I have a tax strategy. How do I now implement my wealth strategy to my financial plan, to my investment strategy? Right? Our traditional approach is, let's talk about an investment strategy and then figure out how it fits into my tax strategy, into my wealth strategy, and my financial planning strategy.
Hmm.
So we have to start with taxes first, especially if you're a higher net worth individual out there. It starts with income, because again, not giving tax advice, because you and I decided on different designations in the CPA, and that's why we have some great partners that will always help us out. But income's a big part of it. If you're a high income earner, what do they call Henrys? You have less opportunity to reduce taxes through an investment strategy. I mean, you talk all the time, right? What are you reserved to? I mean, how can you reduce taxes if you have W-2 income?
There are things that are out there, and this is where we review it through the clear picture analysis, and having that conversation. Yeah, and so when I present those ideas and solutions, and it does take time to execute and implement, This is where we build a team of professionals around our clients. Like I will go, okay, let's work with your accountant. And then I have the conversation with the accountant. Oh my goodness gracious. I will say when I find one that actually knows what they're talking about, it is so refreshing. There's really good accountants out there, but I will say I've had conversations with accountants and I'm going back to the client going, we got to find you a new account because this person had no idea what I was even talking about. And it's their job. This is their job, right? And like what percentage of the Internal Revenue Code is written for how to pay taxes versus how to lower taxes? Do you remember what we talked about, I think, earlier this week?
Yeah, I did. I looked at the percentage, but I think the overwhelming consensus is that the tax code's made up of about 5,000 pages, and like I think 4,995 are how to reduce taxes, and the five are about how to collect taxes. So the tax code was built as a partnership with the U.S. government. If you think about it, if they want houses built, what do? They give you a house benefit. If they want energy production, they give you drilling credits, right? And so if you can understand the tax code and have a really good tax partner that understands you, man, you're that whole opportunity board from an investment standpoint is expanded beyond just buying a good stock portfolio that you get the benefit of tax loss harvesting, if you want to call it a benefit, on the years the portfolio is down. It's extremely important, but
Oh, when you say if you want to call it a benefit, let me give an example, right? So I have this awesome couple who are going to be selling their business for about $4 million in profit in the next 3 to 4 years, and so we started an aggressive tax loss harvesting strategy using actually two different approaches. One was very aggressive in looking at the sectors of the economy and capturing losses where we could, which is for a longer term goal, but then also direct index investing, which is something that high net worth clients are asking me about more and more, and I'm bringing to their attention. But by both doing the tax loss harvesting, with the money that they have, there's a good chance that we're going to be able to get pass forward losses up to 2.5 million, according to their accountant. Right, that 20% on the capital gains on 4 million versus 2 million or 1.5 million. That's a game changer. That's more money in their pocket, less than Uncle Sam's. And then what we could do with the rest of the money that's subject to that is we could do other things to defer those taxes and spread it out over a period of time. But I couldn't even start the conversation unless we had a really good tax loss harvesting approach to then be able to offset the capital gains taxes from the business sale. So we talked
well,
about W-2, right, Andy? But then also
yeah.
business owners, I got to tell you, you mentioned all the pages of the IRC that are written about taxes or about tax mitigation. How many of those pages, right? And I don't expect you to know the percentage, but how many was written for business owners versus
Well, the
W-2?
majority. Yeah. Yeah. Well, the majority of it's there. And so really understanding, is taxes. And back to your earlier point on all this stuff, just like developing a private investment strategy, how long is it going to take you to realize that tax loss harvest strategy, through direct indexing? It doesn't happen again overnight. I mean,
So nothing worth doing is going to happen overnight. It's going to be a plan, a strategy, and it's going to take time. But it's that conversation, it's the communication, it's that transparency, it's making sure that we're aligned with our clients. I think is so important, and it's through our clear picture approach. It's just providing that clarity, making what could be opaque clear by
yeah.
just providing the transparency, and then having the conversations like what we just had. Well, my name is Jason Noble. Andy Merchant joined me today on 20 Minutes of Clarity. We're going to do more of these conversations because we want you to hear what two professionals are talking about when we're not in front of our clients, just talking with each other, spitting back and forth ideas and scenarios. You heard things that we agreed on, and there's also things that we had adjustments on. That is Andy and I's relationship. We are always challenging each other to get better, and you're going to hear us more on this podcast of doing that. I hope you found this enjoyable. If you have any questions, please reach out. Okay, go to clearpicturefinancial.com, enter in your information, and you will hear from someone on our team that will reach out, have an initial conversation with you, and schedule a meeting with either me or Andy, or sometimes both. Okay, depending on the complexity of your situation. We're here to help. Look forward to talking with you soon. Be well.